Good evening, everyone. Thank you for attending the webinar by Philip Future and Eurex. My name is Kent, Eurex sales list based in Singapore. Let me show my screen to you. I will turn off my screen so that you can focus on my slide. Eurex is one of the leading European derivative exchange, ranked #1 exchange globally by open interest. Eurex open interest increased 10% per annum. We offer more than 2,400 products covering international benchmark products, the most liquid fixed income market in the world, and the open and low-cost electronic assets. Driver for global standard in derivative tradings, Eurex extended its phase 1 trading hour on 10th of December 2018 to provide coverage during the Asian time zone. Selected liquid benchmark products such as STOXX 50, STOXX, fixed income like Bund Bubble Shark boxes, as well as MSCI future available during the Asian hours. As for now, we have total 162 MSCI futures available in all time zones. Market opening is at 8 morning Singapore time, 21-hour continuously trading until 4 or 5 a.m. Singapore time. End of the trading and clearing day unchanged. Assets and all infrastructure remain the same, also such as risk, trading platform, clearing system, and so on. We, however, extended our services by having new client service, market supervision, risk and clearing team sit in Singapore and cater to our client in real time. As for 7 December last year, we have extended the phase 2 trading hour of an additional 4 future products into the Asian time zone. The products such as 10-year Euro odds, Euro stock bank, stock Euro 600, and restock futures. Answer demand for future trading and hedging opportunity for our global clients, but in particular those based in Asia Pac who are in the first time zone reacting to the market news and events. Approximately 5 million contracts traded by our member in this year, and more than 27 million contracts traded during the Asian hour since it launched. High volume in Asia MSCI futures during the Asian hour, Eurex hold more than 85% market share globally on Asia underlying. Last but not least, I would like to thank Philip Future again for partnering with us in this webinar. Hope you enjoyed the presentation by Daniel. And over to you, Minghui. Thank you.
All right, thank you, Ken. Moving on to our main speaker for the night, we have Mr. Daniel Ang, professional trader who will be discussing rising inflation, governmental policies, and their impact on the Dow, the DAX, and STOXX 50. Before I pass this on to Daniel, I'd just like to inform you that if you have any questions throughout the course of the webinar, whether about Eurex or the markets, please feel free to drop them into the questions box as we will have a live Q&A session towards the end. And now without further ado, let's have Daniel speak to us.
Hello, good evening to all of you. Today marks the beginning of the second quarter for 2021. It's going to be very exciting. And I hope you guys will stay towards all the way to the end because I have a lot of things to share with you. Now, over the last 15 months or so, we know we have been in a very extraordinary time because of the pandemic, and there's a lot of things that's happening in the global marketplace. I'm sure you guys in Malaysia are also acutely aware of the negative impact of the COVID-19. And without much ado, and the topic for today is basically to talk about the key drivers that are impacting global markets, in particularly the major economies such as the US, And also, one of the markets that Asian investors has largely been not been very actively involved in, which is the European market, which is what we're going to talk about tonight. Okay, and other than the pandemic and the effects of the pandemic, we also want to talk about something else that is currently the main theme for financial markets right now. Okay, before I go any further, let me talk about this. Okay, this presentation is definitely not an offer to buy or sell any securities. And of course, you understand the trading of any kind of leveraged products like futures and options do carry risk, although the rewards can be equally rewarding. And you will understand that wherever there's risk, you will have to look into your own personal risk profile, as well as your basically your suitability to trade any kind of leveraged products. Now, the opinion I'm going to share you this evening is going to be all my own, and please do not hold my company or me personally liable for anything that you do as a result of this presentation. Now, without much ado, let me get into the presentation proper. Like I said, one of the major driver, which is has been the talk of town since March this year, especially in the States, because later on I will show you certain statistics regarding why this is going to be a major theme going forward. This headline came in immediately after the release of the May CPI, which is the gauge for domestic consumer price index in the States, and it is already at a 13-year high. The number for the May CPI in the States is 5%. Now, if you remember what the Federal Reserve, is the Central Bank of the United States, their target rate for inflation all this while since the start of the global financial crisis in 2009 was to achieve 2% GDP growth as well as 2% inflation rate. Now, at 5%, and we are only 5 months into the 2021, the inflation rate on an annualized basis is already at 5%, which is already more than double what the target rate is, what the Fed is targeting. So going forward, the investing public is very concerned as to whether this inflation is temporary or is it going to be more persistent. And if it's going to be persistent, what the Federal Reserve is going to do. Now, we all know Federal Reserve as a central bank basically have policy tools which they can use, namely is to adjust the interest rates. Now, interest rate currently, because of the start of the pandemic in 2000 and or at least, you know, when WHO announced the COVID-19 as a pandemic in February, the market actually has a wholesale collapse in aggregate demand. Okay, so what happened is from that point onwards, the Federal Reserve, in order to stabilize the economy and to get liquidity going again, has lowered down interest rate to near zero. So that allows massive liquidity to be available, because if you look back in history, in 1928, during the Great Depression in the States, of course, in those days, the world is not globalized. So what happened in the States stays within the border of the United States. During that crisis, when they have a market crash and the market went into a depression, the Federal Reserve tightened interest rates. Okay, it means they raised interest rates, and that has exacerbated the crisis, and it took them a lot longer to get out of the depression during 1928. Okay, so this time around, they have some experiences. Okay, like I said, in 2009, of course, we have the global financial crisis, and we all know that Lehman Brothers collapsed. And the Federal Reserve, having learned their lesson from the last Great Depression, allowed interest rate to go down to near zero. Okay, and that allows the market to slowly recover. And that also started the 12 years bull run that we are seeing up to this time, up to this day. Okay, and at the start of the pandemic, the same thing happened. Prior to that, the interest rate was already gradually going up. And on the onstart of the pandemic itself, the Federal Reserve once again lower interest rate down to zero. So interest rate is at zero. So they basically have no more policy tool to use. However, they also employ certain unconventional monetary policy, which is to inject massive amount of liquidity into the system by way of asset buying. What it means is quantitative easing. Quantitative easing is actually a very unconventional way to manage an economy. Okay, we are not going to go into details of those policy responses. However, we're going to be concentrating on first the United States, because the United States, after all, is the largest economy in the world. So I will basically be showing you why this inflationary fear that the market has will eventually also carries out throughout the entire world, in particularly the Eurozone. Okay. To show you how severe this thing is, the next chart will show you a chart of the OECD. OECD is a grouping of more than 100 nations, whereby initially it was organized, it was set up back in just after the Second World War in 1948, basically among the Europeans to make sure that they are able to administer the program for Marshall Plan, which is basically a reconstruction plan for Europe after the devastating World War II. Okay, so this is an extension of that. These days it covers more than 100 countries around the world. Basically, it's just to coordinate economic policies. From this chart, you can see that on the extreme right, you can see the United States. When you see the X, the zero, and the diamond, basically at the bottom of the left-hand corner of this chart, you can see the legend goes at the total amount of inflation, which is represented by the circle. In the States, is at 5%. This is annualized, and it's the latest. And if you exclude food and energy, which is the two major volatile component that the core CPI index is not inclusive, this is 5%. However, if you include energy into the mix, then you can see in the States that the inflation is way, way high. It is way above 25%. And we all know since the beginning of the pandemic, crude oil prices has been on the rise and rise, even up to this very moment. Last I checked, the WTI crude oil contract traded in NYMEX is at $76 per barrel. The Brent crude oil is trading at $78 currently. So you can see that market is looking towards ever higher energy prices in terms of crude oil. So for the States, it's particularly acute because if you look across this simple chart, you can see that North America has the worst inflationary pressure right now, including Canada. However, if you look to the left or the center of the chart, you can see that most of the other OECD major economies, including Germany, France, UK, and even Italy, you can see the referring to the circle, the legend circle, you can see the inflation in Eurozone is actually quite muted. Overall, in the Eurozone, the last number that we saw was 1.9%. So 1.9% is not too far away from their target rate of 2%. So the ECB also have a 2% inflation target, and prior to the last release was 2%. So we are still good, because basically the Eurozone inflation target is not as bad as what appears in the States. But because the States is the major economy, what happens in the States, especially what the Federal Reserve is going to do, will definitely have a knock-on and consequential effect on the rest of the major economy, including the Eurozone. So watch this. But what are the major causes of the spike in inflation? Now, we all know that going into 2020, there was a trade war that's raging between the US and China. So even after the new administration came in at the beginning of 2021, you can see that the trade war did not necessarily go away. In fact, the tension between US and China has actually accelerated. So that is one component, okay? Now, when the pandemic hit, policymakers all over the world have a knee-jerk reaction. They lock down the economies worldwide. So the immediate impact was global supply chain was broken, okay? If you look at the freight rates, means whatever shipping companies have to pay for shipping goods between countries, okay, between ports, you can see the freight rates have actually escalated. You can see the one that I highlighted. This report came in last week. It was on the Singapore Straits Times. So you can see that the rates for a trip to China to the west coast of the United States is currently nearly $7,000. And this is remarkable because this is triple the rate pre-pandemic times. So at this time, if you remember back in late March, if you can imagine or remember the image on television whereby there's a huge container cargo ship that was stuck in the Suez Canal. That exemplifies how bad the situation is, because the Suez Canal, on the average, about 12% of global trade passes through the canal. So if it's if it's stuck off for whatever reason become unaccessible, all container ship will have to do have to take the alternative circuitous route via the Cape of Good Hope in South Africa before coming to Asia, or the other way around. Okay, so that increased the time, increased the cost of transportation. So this is what is still currently happening. Okay, although the economy more or less has waiting to recover in especially in America, they are looking to reopen the economy because after the massive rollout in vaccination, and right now, of course, we are in the middle of summer right now, and US is just getting out of their July 4th holiday, which is their Independence Day. There's a lot of Americans out and about going out to enjoy the game, going out to enjoy themselves. And of course, in Europe, we have the UEFA Cup going on. You can see the stadiums are packed. People are behaving as if the pandemic never really happened. Okay, so you can see the demand is already there, coupled with the fact that there is this disruption in global supplies. Okay, when we look at the big picture, the macro picture, okay, as much as the US wants to buy less, want to correct the trade deficit with China, the fact remains China is the only place they can get whatever they want. Okay, all the whether you are buying it online or within the store itself. Okay, most of the goods have to come in from China. China, after all, is the first to recover from the pandemic, and it's quite sad because after the very disruptive trade war between China and US, okay, now we have China still being the only viable place to get whatever the Western people want in terms of their demand for physical goods. Okay, so that remains. So this is exacerbating the inflationary pressure, because on many fronts you can see that there are many elements in place here. Okay, later on I'll share with you why we are looking at exchange rate is also an issue. Maybe it's a policy response from China, and of course we know that the Americans depends on retail sales. 70% of the US GDP is made up of retail sales. So if the consumers do not spend in the States, the GDP will suffer. And now they are expecting 6.5% for the entire year in terms of GDP in the States. Now, this is the freight rate. This is the latest, and this is live. You can see that from Asia, obviously we're talking about China, to the west coast of the United States. This is an average rate. This is a global index which is hovering just above $6,000. For America West Coast, is more like nearly $7,000. And if the freight rates for East Asia or China, particularly to the East Coast, which is not on the New York side of the American mainland, the freight rate is hovering just under $10,000. So this is massive, and it's adding on to the cost of everything that Americans need, whether it's input costs or whether it's consumer prices. Okay, so this is currently something that is ongoing, is unlikely to ease in the near future. So when we talk about the Federal Reserve Chairman said that the inflation is going to be temporary, the picture doesn't point to the same direction, or at least not for now. Okay, so we will have to understand that what is being told to us, because the Federal Reserve Chairman cannot say what he wants to say, because that will cause enormous panic in the financial markets. Okay, so what he's trying to do is to make sure that everybody stays calm and rational. So as investors, we have to be very clear what is transpiring right now and how are we going to position ourselves. Now, if you compare this insert chart, okay, you can see that there's a blue line and a green line. The green line basically depicts the average freight charges last year. You can see this year, which is depicted by the blue line, it is rising, and it is looking and it looks like it is going to continue. Okay, so going forward, like I say, I do not believe inflation is going to be temporary. Okay, I have a different view. Now, this is for the number for May. Not on the left, you can see that this US inflation rate refers to the CPI, which is the Consumer Price Index. For the month of May, on an annualized basis, it is already at 5%. Like I say, this inflation actually accelerated somewhere in March, right after Biden has been sworn in as the new prime president. Because when he was signed in, and the first thing that he did in terms of his executive orders was to launch very ambitious stimulus packages, and this one did not stop. The last one that we know of is his infrastructure plan, which just has a bipartisan support although he didn't get exactly all that he wants, but it's still a massive amount of money that he's want to spend. And so that is what is happening right now. The Federal Reserve has to create the liquidity necessary to support this new program. So going forward, there will be a lot of things that we all have to watch about, because the US national debt is getting out of control. Okay, so that is on the consumer side. On the producer side, which is the PPI, which is the chart on the right, you can see that the PPI is even worse than the CPI. It's at 6.6% for the month of May. So the next update will be next Tuesday. So next Tuesday, CPI numbers for the states is going to be it's going to be watched like a hawk, and I think the number will still be high. Okay, relative to what the number we are seeing for May. So there you have it. Inflationary pressure is definitely hit in the states, and whether it will spill over to the rest of the world is something that we all want to watch. Okay. Now this is the dollar index. Consequentially, okay, at a time when the US economy, or rather the stock market, started to stabilize and take off, you know, in the aftermath of the pandemic declaration by WHO, the US stock market actually crashed, and that was the fastest, the fiercest, the sharpest fall in the history of US equity markets. The market lost more than 20% in just a month. Okay, and that's fast, really fast. And thereafter, the Federal Reserve came in to stabilize the market by, you know, relaunching quantitative easing, as well as to bring the Fed fund rates down to zero, okay, almost zero. And that allows the markets to at least have some breathing space, thinking that knowing that the federal the policymakers is supporting the the economy. So that caused the market to stabilize and the market recover in terms of stock market prices. So the current stock market rally that we are seeing in the States, okay, started from almost the end of March last year, and it has been ongoing. As of last Friday, before the break for the July 4th holidays, the S&P 500, the Nasdaq, okay, all closed at record high. Okay, so we all have to know that the market is still very, very buoyant for US equities. Will that be so for European equities going forward? We will have to see, okay? Also, at the same time, when the economy took off last March, the dollar started to come off. And I think this is a deliberate policy. This is a policy move, okay? A lot of people associate a strong country, a strong economy with strong currency. And this couldn't be further from the truth. Because if you are exporting countries, you do not want a strong currency. Because if you have a strong currency, because you understand whatever you're selling, okay, you will always have competitors. So if your currency is strong relative to your competitors, you do not have the competitive advantage. So most exporting countries want to keep a relatively stable and weaker currency, so that they have another competitive edge. So the US dollar has been coming off since last March, okay, and it only started the rebound back somewhere in the end of May this year. So for the last 2 months or so, for the last month or so, you can see that the dollar has been rebounding, and this is to me a technical rebound. Over the long term, at least in the medium term, I think the dollar will have to come off again. So on the right, you can see there's a dollar versus the yuan. Okay, the dollar versus the yuan is obviously reflecting the dollar as one. How many Chinese RMB do you need to exchange for 1 unit of US dollars? And you can see at the same time when the dollar is falling, it's also falling against the RMB. Okay, and the fall has actually accelerated. That means consequentially, conversely speaking, the RMB is strong. Now, we all know that input cost has escalated. Okay, China imports a lot of stuff from the rest of the world in terms of raw materials, and in particular is iron ore. Iron ore is what you need to manufacture steel and roll steel, and the cold roll and a hot roll. So basically, you need iron ore, and iron ore prices you can see is on the up and up, and it looks like the gradient is a lot sharper. So with the input cost costing more, so China basically have two choices. In order to compete, okay, they ideally must be able to lower their price. But this situation after the global lockdown last year created a situation in which the Chinese do not have to worry about price, because there's simply no viable supplies, alternate supplies basically, okay? China, after all, control more than 54% of the global steel market. So what China did recently, okay, in recent months, is to ban the export of steel, which the world needs, and in which US imports quite a fair bit. They have their own steel mill in the States, but not enough to supply domestically, so they have to import. So China has banned the export of steel because the official reason is they have to satisfy the domestic market. And China, steel is just one example. China now has increased price of all their exports. The whole idea is this: since their input cost in terms of raw material has escalated in prices, they do not want to absorb the inflation. So they are exporting inflation to the rest of the world by because right now there is no alternative, viable alternative for their for imports other than from China. So China's goods now can command very high premium, which they did, and coupled with the fact that the RMB is now strong, so the Chinese has basically re-export inflation to the rest of the world. So that's why you can see in the States the inflation is so severe, because as much as they want to decouple, they can't, because at the end of the day they still need to buy from China. So this is what is going on, and it's also one of the reasons why I believe inflation, at least in the short to medium term, is not going to de-escalate. Now the Fed policies, the Fed is, as a central bank, basically has a mandate to encourage economic growth as well as to ensure stable prices. That means to say they must keep an eye on inflation. So right now, the economy seems to be recovering because the low base of what happened last year after the market crashes, the economy is recovering from a very low base. So in fact, so bullish, the policymakers in the States, they are predicting or at least forecasting a growth of 6.5% for the entire year of 2021. And this is fantastic numbers. Okay, because for a mature economy like the United States, having 1 or 2% annual increase in GDP is what is normal. Having 6.5% is abnormal, and of course, it's something that to cheer for. However, with the inflation also escalating at the same time, so the Federal Reserve will have to find a way, okay, within their toolkits to see how they can mitigate the rise in inflation. Right now, they don't have policy tools because they can't raise interest rate right now. Now, you must understand the US national debt stands at $28 trillion. Any basis point, which is 100 or 100, okay, is what we call a basis point. Every basis point increase in interest rate is going to add on to the burden of servicing this massive amount of debt. Okay, so the policy tools, the hands of the Federal Reserve are tight right now. They cannot raise rate. So the next thing people will be looking at, are they going to slow down their QE? And officially, the Fed said they won't be looking to slow down the QE. They are maintaining about $120 billion worth of purchases of securities, as well as MBS, what we call the mortgage-backed securities, to the tune of $120 billion every single month. So looks like, for all intended purposes, the Federal Reserve can't do anything right now. However, they did mention during the last FOMC meeting that the Federal Reserve is going to bring forward the timeline for a rate hike from 2024 to 2023, not once but twice. Okay, so the market is conditioning. Of course, the initial reaction was the market came off, but then after a while, the market has come back up to new high again. Okay, so this is exactly what happened during the last FOMC meeting. Right after the meeting, Federal Reserve Chairman Jerome Powell actually mentioned that the timeline for the rate hike is going to be brought forward by one entire year. Okay, so you can see this is the Fed fund rates. Fed fund rate is almost zero. Okay, there's something else I want to share you, but I don't think we have time for that. So like I say, I'm not going to concentrate too much on the US itself. I'm going to talk more about the European economy. Now, the EU, which is the European Union, was actually created, okay, as a concept. You know, the last two world wars all started from Europe, and the last war was actually very devastating. Okay, there's a lot of destruction, lives are lost, and they want to prevent another possible war from erupting again in Europe. So the whole idea of having a United States of Europe was the idea. Okay, however, because of sovereign concern, nobody wants to give up the sovereignty, and to have a United States of Europe is actually nice in concept, but it's almost unachievable. So the next best thing is they agree on at least an economic union. So the Maastricht Treaty, which was a treaty signed in the city of Maastricht, was actually where the European Union was actually born. And subsequently, 5 years later, they launched the euro, which is the currency that we know today. Previously, there were Deutschmarks, there were French francs, there were Italian lira. So all kind of different currencies for each different countries. So now they commonly use one common currency called a euro. Okay, and 2002 is when they actually printed physical the euro notes and coins. Okay, so this is the basic structure of the European Union. Now, in the Eurozone itself, now the Eurozone is very different from the European Union. The Eurozone refers to, or certain articles will mention that it's called Euro area. Basically, it means the same thing. It defines countries that use the euro as a common currency, and there are 19 of them. Okay? So the 19 countries that use the euro as a country as a currency is called the Eurozone collectively, of which the Germany is the largest. Germany share of the total GDP of the Eurozone is 29%, followed by France, Italy, Spain, and the rest. Okay, and of course on the expenditure side, what do they spend on? Most of them will be on household consumption. So you can see that very much like the US, okay, domestic consumption is a major component that makes up the GDP. In the States, it's 70%. In Eurozone, it's just marginally above 50%. Okay, so you can see the bulk of the expenditure for that make up the GDP in the Eurozone is still domestic consumption. Now, earlier on, I mentioned global inflation is here, and it's the highest since the last financial crisis that we had in 2008. Now, the OECD is made up of 38 countries that accounts for roughly 60% of the entire global economy. So by looking at the OECD numbers, we can have a very good idea of where inflation is relative to the other major economies. Okay, and at the current rate, you can see on this chart here, you can see that all items and the light turquoise color line refers to everything else excluding energy and food. And as I mentioned earlier, this means they are taking up two volatile sectors, which is to me unrealistic, because we all know energy is again on the rise, and as of today, it is at record high for the last 2 years. So energy is a major component. So if you include in the energy cost, food prices has not escalated very much yet, but it will come because the global climate is changing, and it's not necessary for the better. Okay, so eventually we will have to contend with food inflation as well. For the time being, the energy component of this inflation is actually quite bad. Okay, at 3.3% if you take away, if you include in the cost of energy and food. Okay, so you can see in the Eurozone, it is also a rising inflation scene, although the numbers does not really show individually in every country. Okay, so the annual growth of the Eurozone itself, you can see that they have it very, very bad, you know, in the middle of last year when they have a recession, because in the aftermath of the lockdowns, supply chains were totally disrupted. Nobody was spending because you can't go out, you can't go to the theaters, you can't go to the restaurants, you can't basically move to be out and about. You can't spend. So most of the people will stay home, and that changes consumer behaviors in a very, very impactful way. Okay, of course, we all know that at the start of the pandemic, where everybody had to stay at home, work from home, the demand for electronic products in terms of equipment that we need to work from home, okay, has actually increased by a lot. And of course, everybody pivot towards e-commerce, and that consumer behavior change is impacting how the sectorial moves in the equity markets. Okay, of course, we're not going to go into that. There'll be too much time for things that we don't have. Now, the inflation in the euro area is also mean that the Eurozone. You can see that the last number was 1.9%. It is not excessive because, like I said, the ECB target rate is 2%. So we are right within the target. So right now, for a time being, it is not a major concern. So between the United States and the Eurozone, the ECB is taking a more relaxed approach. She said, look, this is happening across the Atlantic, nothing to do with us, at least for now. Okay, so, but we cannot deny that whatever the Federal Reserve do going forward in their effort to control inflation, at least to mitigate it, will have an immediate impact, you know, on the rest of the world, including the Eurozone, whether your inflation numbers are high or not. Okay, so we will have to keep an eye on the United States because their policy will definitely impact all of us. Okay, now one of the major things that the Europeans has seen an increase is the import prices. Now, for the production of anything, whether it is cars for Germany, especially Germany being the largest economy within the Eurozone, the import of steel is going to be a major concern. You can see the import prices has escalated. Okay, you can see from last year, it was hovering below the reading of 100. Right now, for the last number that we have is 103. So you can see the curve is actually pretty steep. Okay, and that has got to do with a lot with not only the import cost of steel. Okay, it's also energy prices. Like I mentioned earlier on, going into today, this chart on the right shows the WTI crude oil prices. It was trading at $75. Today it's at $76. Okay, last I checked was $76. So you can see the prices has been going up and up and up and up. Okay, since the beginning of the year, it's already up by more than 50%. So OPEC is hoping to cash in on this elevated price in crude oil energy prices. I think some member states are already itching to increase production. If that happens, of course, in the short term, that will be good news because that will allow prices to at least come down a little bit. But overall, most of the analysts are looking at $100 per barrel. So if that being the case, inflation is not going away anytime soon. Like I said, the impact of exchange rate. Now, while the US dollar has been coming down since last March, okay, until sometime in March this year. So for the last year, month and a half, the dollar has rebounded. Consequently, you can see the euro as a chart. You can see this chart on the right reflects the exchange rate between the euro versus the US dollars. In this case, the euro is the base currency, is pegged at 1 unit. How much of US dollars do you need to exchange for the same 1 unit of euro? So the chart shows a gradually rising expression of price, meaning the euro has actually appreciated relative to the US dollars. You can see at the high this year, which is May, the rate between the euro and the US is 122.60. Of course, it has come down since, and for the year to date, it is negative almost 2.9%. So how does this impact? You can see that if Europe wants to mitigate the import cost inflation, they will need to maintain a strong currency. However, Europe depends a lot on export, especially Germany, because their major products in which they export are vehicles, cars, okay? And if you have a too strong a currency, you can't compete, okay? So basically, right now they are caught in a catch-22 situation in which to whether to adopt a strong currency or not, it's not so much dependent on them anymore because the United States is maintaining a weak dollar policy. Okay, so relatively speaking, all the other currency will have to go up. Okay, so EU trading partners, the majority of the trading partners, you can see Europe trades a lot with China. China, you can see on the chart on the left, we have an orange bar and we have a blue bar. Okay, the orange bar shows the imports that they make from China relative to the export. So they sell less to China than what they import from China. And China has increased the price of the finished products, and coupled with the fact that they are also maintaining a strong RMB posture, meaning to say that import prices is not coming off anytime. Okay, on the chart on the right, you can see that now instead of a euro dollar, you have a euro RMB chart. Okay, the euro is declining against the RMB. It means everything that they import from China will cost a lot more, and it looks like it will probably cost a lot more going forward. Okay, because the charge gradient seems to be coming down. Okay, so all these are background to why I think we all have to watch out for the different factors that cause inflation in the Eurozone. Of course, in the Eurozone, we also have unemployment, but unemployment has come down quite a fair bit, although this is still elevated. Okay, on the chart on the left, you can see Eurozone unemployment rate is just under 8%, which is still high. Okay, US is already at 4.6, which is like almost half the unemployment rate in the Eurozone. The Eurozone has a lot of unemployment. Among the states itself, they use the euro as a currency. You can see that Spain has the highest percentage of unemployment among their youth. Okay, 15.3%, which is a terrible number. Even in Germany, you have 3.7. Anything that's below 3% is considered as full employment. So everywhere you look, even with the best, the Netherlands is at 3.3%. So it is on a whole, okay, still pretty high. Okay. So on an annualized basis, you don't see it that much. Also, the last number that we see was in April. We haven't had the release of the May figure yet, and you can see the PPI is way above the CPI. So the manufacturers, are getting it full blunt, okay, because of the import prices caused by the currency rates, and of course the increase in freight charges, and Chinese maintaining increasing price, as well as maintaining a strong RMB posture. So you can see the import prices will continue to escalate, and that will impact eventually on the main consumer prices. Okay, so the rest I'm going to show you now. So money supply, very similar to the policy response of the Federal Reserve. You can see this curve on the left. You can see that this is like a mountain, and the angle is very steep. Okay, in terms of how much money the ECB has pumped into the system, it is way more than the American. Okay, you must understand that the European economy is not as big as the American. However, the amount of liquidity they have in the system is so much more than the United States. The amount of liquidity available, or what we call the monetary base, is above 10 trillion euro. Converted at the exchange rate of 1.185 is equivalent to 12.5 trillion US dollars, and that's a lot. Okay, right now the US is struggling with too much liquidity, to the point whereby the Fed is busy absorbing, or at least draining, the economy out of the liquidity, and that will have an impact, because if the US starts to drain liquidity and the European do not, then there will be a flight of capital. Okay, of course that will be another topic. On the other hand, you can see the interest rates for the Eurozone is also at 0. In fact, it actually was negative. Okay, if you look at the deposit facility rate in which the bank can charge, okay, it's actually negative. Okay, so you can see this is even worse than America. So it will have consequential. Basically we will have the day of reckoning, and it's fast approaching. Okay, the balance sheet. I say the ECB balance sheet in terms of their QE program. Now, at the start of the 2009 crisis, the ECB has gone on an unlimited QE. Remember, the previous president of the ECB was a guy called Mario Draghi. Okay, he maintained that he needs to continue with the QE program to the tune. Right now, of course, there's a new president in charge. Okay, and the ECB now is run by Christine Lagarde. Okay, Lagarde, which was the president for the IMF the last time. Okay, so the amount of balance sheet they have is $7.9 trillion in euro, $9 trillion in US dollars at the current exchange rate, and that is massive. Okay, they will have to deal with this, because this created to a point whereby the bond market is basically destroyed, because the ECB has become the largest buyers of all, not only government bonds but corporate bonds. If the ECB stop buying, the market will collapse, because simply there won't be any buyer bigger enough to absorb the amount of bonds that need to be purchased on an ongoing basis. So the ECB has maintained that they will not stop the purchase of assets, and they are in fact going to accelerate the program. Okay, so this is the Fed balance sheet. In comparison, you can see that the Fed total is $8.1 trillion as of June 24th, and the European ECB balance sheet is at $9.4 trillion US dollars. So not comparable, because the size of the economy is not. Okay, now of course, before this month, anything below 22 euros in terms of imports are exempted from this thing called the value added tax. We can understand it by what we call a GST. Okay, it is a sales tax, but they call it a VAT in the Eurozone. Before this month, anything that is below $22 will not be subject to VAT. However, now onwards, everything will be subjected regardless of the value. Okay, and this VAT is charged very differently from country to country within the Eurozone. You can see that Hungary charged as much as 27% in GST. Luxembourg charged 17%. No matter how you slice it, the VAT is pretty high compared to what we are paying in our region here. Okay, Singapore, we are paying 7% already. We are complaining if it rises to 9%. So you can imagine paying double-digit GST. And this is exactly what happens, because the government itself has no other tools but to tax, and this is a way of taxation. And taxation means it is definitely going to be a regressive kind of approach. Now, the minimum wage is another concern. Okay, we do not have minimum wage policy in Singapore, so I don't think there's any minimum wage in Malaysia. Okay, but in the Eurozone, they believe that they need to support the not so well off. So by allowing a minimum wage, and that should provide some kind of ballast to the economy. However, minimum wage must come with rise in productivity. If you have increase in wages but not a corresponding increase in productivity, this is a negative. Okay. Again, this is a report they can find on Eurofound, detailing the entire year minimum wage outlook for the entire Eurozone. This is a very good publication. If you really want to, you can go and search under this Eurofound. Just search under minimum wages in 2021, and you will get this report here. Okay, the policy response, like I said, for the ECB, Christine Lagarde is the current ECB president, and she took over from Mario Draghi, and she maintains most of the Mario Draghi policy of asset buying. Okay, and he says they're going to leave interest rate unchanged, and there are no changes in the bond buying, and in fact they're going to accelerate the program. And because of the pandemic, they also have this thing called the PEPP, okay, which called the Pandemic Emergency Purchase Program, and they're going to continue to buy, okay, to the tune of 1.85 trillion euro dollars. Okay, and of course on top of that they have the APP, which is the Asset Purchase Program, which is another part of the QE program. They're going to go to the tune of $20 billion. Euro, not dollars, euros. Okay, so you can see that they are leaving everything unchanged because they feel that inflation is not a problem yet. They don't have to deal with it because they think that the inflation in the States got nothing to do, at least doesn't reflect the same situation, the dynamics in the Eurozone. So we don't have this issue here. So the question we need to ask is inflation temporary, or is it going to be here to stay for a while? Okay, my take is that I think policymakers cannot tell us what we need to know, which is to say that inflation is likely to get from bad to worse before it gets better. Okay, but they can't tell us, because if they say so, then what will happen is that the market will go into a panic mode, and that is not necessarily a good thing, right? Okay, so we all have to understand what you got to call a spade basically. Okay, so if you are not, then you have to only react to the markets. You must understand central banks are not proactive by nature. They will only act after the fact. Remember, after the pandemic hit and the stock market crashed down for a month, then the Federal Reserve, okay, started introducing QE and bring down the interest rate down to zero again. So they are more reactive than proactive. So they will not deal with the problem until it becomes a real problem. So again, if you want to wait for them to tell you that this is a problem, but then it will be too late. Okay, so as investor, as trader, we need to be able to understand that we need to see the picture a lot clearer and not depending on the media telling us what's actually happening. Now in the Eurozone itself, especially Eurex. Now, do you know that Eurex is a very, very important exchange, because they are the third in terms of total volume traded around the world, and it is a major exchange. And the Euro Stock 50 actually is a composition very similar to the Dow Jones. In the Dow Jones, we have the top 30 stocks, bluest of blue American companies listed in the American Stock Exchange. And in Eurozone, you have the Euro Stock 50 stocks. These are the bluest of blue, and the stocks listed there as the component stocks come from different part of the Eurozone, with France leading at 17 companies. The Germany is just behind at 16 companies, and it goes down the line. You can see that the table on the extreme right corner there. You can see the composition that makes up this index itself come from these various countries, and the component stocks will keep on to be updated. So at this current moment itself, as of April 2021, this is exactly what it is. Okay, so by having exposure in this particular index, then you can actually use this, okay, to take advantage of what is happening in the Eurozone. As much as you can trade the American equity index, now you have another area in which you can actually take advantage of. Remember, Europe is straddled between Asia and the United States. So this time zone is actually quite ideal for us to trade, because we don't have to be, you know that the US, as far as New York is concerned, is at least 12 hours, behind us. So for us to actually trade the American markets, it's a little bit of inconvenient for most people, okay? But because the European trading hours are actually more or less almost 24 hours very much these days for electronic trading, but the active hours are actually quite ideal for Asian investors, okay? So today we'll talk a little bit about this. Of course, this is a series of talk that we're going to conduct, and we will talk more about this as we progress this, okay? For today, I just want to introduce to you what's available to Asian investors and traders in terms of taking advantage of the European or at least the Eurozone economy, knowing what we already know in terms of what I have already shared with you. So the DAX is actually a German stock index. I can't pronounce the actual Germany. The abbreviation for DAX is actually German. Okay, so I will not go into it. I'll just tell you that it's a German stock index. Again, comprising of 30 major, only Germany stocks. Okay, so you can see this is a total return index, and it is very much like the Dow Jones or the FTSE 100. Okay, but as you can see, the component stock is only limited to 30 companies. So this is actually quite good. They offer options as well as futures contract traded on the Eurex itself. Okay, of course we're talking about the regular and the mini contracts. But however, starting the expansion of these components, they're going to expand the number of component stock for the DAX from 30 to 40. Okay, so knowing that by the third quarter, which is currently where we are right now, okay, by the end of September, they will somewhere between now and the end of September, they're going to increase the component stock from 30 to 40. Okay, they're going to expand. So now you can see there are three charts here. On the extreme left, you can see there's a Dow Jones Industrial Average. Now the prices is up to 1st July. Okay, you can see that it is already northward of 34,000. Okay, year to date as of July the 1st, it is up almost 14%. And this is remarkable. We are only at the halfway mark already. The stock market, as far as the Dow Jones is concerned, is already above 14%. How do I go back? Let me see. I'll show you. Okay, got it. Now, the chart in the middle is the Euro Stock 50. You will notice that the Dow Jones is not the strongest in terms of major US equity index. The strongest this year are the S&P 500 and the Nasdaq Composite Index. Okay, the Dow Jones is for some reason lagging behind. Okay, however, after Friday last week, you can see that it closes at a new high on the daily basis. Okay, whether it can do it on the monthly basis, we do not know. Okay, but it's very obvious the American stock market is very, very bullish right now. Comparatively speaking, the Euro stock is not as bullish. The European stock, as far as the Euro stock is concerned, the high was traded in 2007, and we are still a bit of a distance relative to where the peak was. So if you look at it from a very positive point of view, that means to say it has a lot more room to go up. Okay, but whether that is the case, we do not know, because again, we have to watch how the global economy pans out going forward in the next few months. And I think we are going to be very exciting going forward, because the market is going to get extremely volatile going into the next this quarter. Okay, I do expect some kind of correction going on within the next few months. Okay, so watch out for this, and there's a lot of opportunity we can do. On the other hand, the DAX mimics the more or less the very bullish outlook relative to the American equity index. You can see the DAX is actually very high. Okay, it's at 15,600, and for the year, it's even better than the Dow Jones. It's up 14.4%. So apple for apple, I think the DAX is a little bit stronger than the Dow Jones. Okay, so there you have it. Now, straight away, if you are looking at only between the Euro Stock 50 and the DAX, here I can see outright, even without doing very deep analysis, I can see there is one strategy you can use. Because the Euro Stock 50 is not as bullish relative to the DAX, can you not buy the DAX and sell the Euro Stock 50? Or it's called a spread trade. And because you see the value of the DAX is at 50, it's a 5-digit, 15,600, relative to the notional value, the index is at 4,000, just below 100. So if you want to do this spread trade, straight away I can tell you, if you want to do this, it's not a perfect fit. Okay, it's roughly about 4 contracts of the Euro stocks equivalent to 1 DAX. So let's say you do not want to play the absolute directional move. Okay, you just know that the DAX is not as bullish as the DAX. And here you can employ one strategy called a spread, in which you can buy the DAX, buy the strongest, and sell the weakest among the two. Okay, and all you need is for this market to eventually close down the gap. Okay, and that is a lot safer than doing outright. Of course, you can do outright. For day traders, obviously doing a spread can be a strategy, but it is a more conservative approach. You know, there are so many strategies you can actually employ. Straight away between the DAX and Euro Stock 50, there is this one possibility here. All right. Now the micro index for these two index. Now this index as a micro index has been is only a recent thing. I think they only launched it in April 19. Okay, so it is only a few months old. But again, if you have the American equity index in terms of a micro as a guide, this is going to be an explosive product. Equity index futures has been the most successful product in any of the futures exchange. I started trading the S&P 500 back in the late 1990s. Okay, and those were regular contracts. But because the stock market has gone up by leaps and bounds, the notional value, okay, if you compute it in terms of absolute dollar value, is already beyond the reach of average investor like you and me, because the margin required will be so enormous that it only can be available to fund managers. So the whole idea of having a micro equity index is to make sure that they bring down the barrier to entry. A micro index, because the multiplier is only at 1. That means to say, if the Euro stock 50 right now is 4,001, the notional value is 4,001 euro. That's it, full stop. It's easy to compute. There's no need to use a lot of mathematics to know the notional value. Likewise, the DAX is at 15,600. The notional value is 15,600 euros. Okay, so you can see that the margin required is obviously going to be a bit of different. The last I know from Philip is that the DAX on day-to-day basis for this micro index is currently at 1,446 in euro dollars, whereas the Euro stocks is only at 356 euros. So you can see that between the two, the more affordable one, okay, at least comparatively speaking, is the Euro Stock 50. So that $350 in terms of euro is actually very achievable, because you and I are typical retail investors. We do not want to park a lot of money, or even if we can, we allow us to able to take advantage of the movements in this product itself. So if you have a view on the European economy expressed in terms of whether it's Euro Stoxx 50 or whether it's the DAX, you can use this micro index, okay, to take advantage of the price action. Because like I say, in the next few months going forward, a lot of things going to happen, and I think there's going to be a lot of volatility. Now, if you are investors, you do not want volatility. You want prices to be stable. But as a trader, you need the volatility, because if the market is as stable as a blue chip, then we all understand blue chip prices do not move very much on day-to-day basis. That means to say that there's very little trading opportunity. We want to have the opportunity for the price to be able to move, you know, within a certain range every day, so that we can take advantage of the intraday move. And a micro index is very ideal. First of all, it is very affordable. It's very what we call retail friendly. The other thing is that if you have any exposure, okay, in any kind of European stocks, an equity index such as a Euro Stock 50 or even the DAX will allow you to do hedging without having you to unload your portfolio. You can actually hedge against in the future contracts. Okay, and of course, being relatively affordable, okay, you can do scaling. Previously, let's say you trade the mini or the regular contract, the amount of capital that you need to commit on any one lot position, okay, is going to be relatively large. It doesn't give you the flexibility of doing fractional pricing. With a micro equity index futures, you can actually do fractional, what you call scaling in, or what you call dollar averaging, basically. Okay, this strategy is only available if you are trading the micro equity index. So you can see there are a lot of things going for it. Earlier on, I didn't mention the regular contracts relative to the micro is 10 times bigger. Okay, so imagine if you had to put in 1,446 for a DAX contract, you're going to put in 10 times more, okay, just to buy and sell one regular contract. The mini contract is half the size of the regular contract, which in turn is again half the size. Okay, basically is the DAX is basically and the Euro stocks are definitely more geared towards the UME. Okay, so the contract specs, as what you can see here, we will not go very much into the contract specs. There will be time for that in subsequent webinars going forward. Okay, so I have more or less finished my presentation for today. I hope I have not overshot my time. I think I did. Okay, now, so next will be the Q&A session. So please restrict your question to the subject matter that we are discussing today. Anything else you want to ask me, you can always reach me via my social media pages. Okay, so can I hand back the mic to you?
Yep. All right, thanks for the insights, Daniel. We actually do not have any questions from the audience tonight. So if there's anything else you would like to elaborate on, we can do about 5 minutes more before I conclude the webinar, or like until we receive a question.
Okay, I'm sure investors and traders alike, Anna, are very keen to know what is going to happen next. All I can say is I can see just beyond the horizon, there's going to be a lot of uncertainty, especially over the fear of inflation, which I think policymakers are not telling us, or at least not calling a spade a spade. Okay, so basically we will have to see how things pan out, but I think it's going to be not so rosy. Okay, so we have to get ready for the volatility that's going to come soon. What I would expect is we're going to have a month of down, a month of up, a month of down, a month of up, all the way until October this year. So it's going to be pretty volatile. So any kind of value investing approach might not work during this phase. Okay, so this phase is actually quite ideal for people who are doing short-term trading. You know, whether you're scalping or doing intraday trading. So knowing that this market is going to be pretty volatile going forward, there's a lot of things we can do. Okay, in the market.
All right.
Anything else?
No, we do not have any other questions. So thank you, Daniel. That was a very insightful session. And since we don't have any other questions, we shall conclude the webinar here. Yeah.
All right. Thank
you
very much.
Yep, thank you again, Daniel and Ken, and thank you very much, everybody, for your time tuning into this webinar tonight. We'll be sending everyone a link to today's webinar recording so you can watch it again if you'd like to. And all Phillip Futures customers can trade the Eurex Microdex and Micro Euro STOXX 50 futures at an exclusive rate of Euro 150. So do visit our website at phillipfutures.com.sg for more information. And that's all for today. Thank you, everyone, and goodbye.